yes, has been a big disappointment, and I myself have admitted in my note that it's been a big mistake. Yes, we underestimated the pitfalls of structured lending, and interestingly, when we were speaking to the corporate banking head at ICICI, the RBI rules are very clear on structured lending and promoter financing. When you're financing anything at the promoter level, that has to be backed necessarily by a good amount of cash flow. Now, what exactly happens in a holding company is that there is no cash flow. There is no operating businesses. So they have holding companies which are operating businesses, but then that underlying itself is also weak. And the only way around the holding companies to service that there is through the dividend model. So just purely because you have some additional shares being pledged as a collateral, then that becomes a collateral dependent lending rather than a cash flow dependent lending, which is what went to some extent awry with both IndusInd Bank as well as Yes Bank. So I think people have really realized the importance of really assessing the risk based on cash flow rather than purely on the collateral. Just because you have 2x collateral doesn't necessarily mean you go ahead and lend it, because recoverability becomes a big challenge. If the stock prices collapse 50% and 70%, you are in a big problematic state. So yes, it's not an easy business to do it, but what exactly happened was that in the pursuit of high valuations, and of course HDFC Bank and ICICI is being very active in the retail market, the only extra uptake came from structured lending. So clearly they were taking high risk, also meant high reward, but then when the risk fructified, clearly they have been caught off guard. So I think going way forward, they have to be a bit more careful towards this, and yes, they have to reorient their business models. Yeah.
Well, Yes, in particular, so obviously, they've been in the headlines, lots of churn at the board level, at the management level. And I see the immediate issue that, there is unsettled sort of environment within the bank. But slightly more medium term, it's good, right? I mean, because the previous management and the previous sort of, overseers got us into this trouble. So if all of that is getting cleaned out and a new set is coming in, medium term, it's good.
Possible, but then, it takes a lot amount of time to clean up it. I mean, one cannot expect a CEO who's been 7 weeks in the organization as having cleaned up the entire bank, right? So I think there's more pain to come. Clearly over the course of next I would say 2 to 3 quarters, you can see more realization of some of the so-called watch lists that they have come out with. So that remains a challenge. And I think 5 board of directors resigning immediately after Rana Kapoor quitting, and all of them quitting because of personal reasons, apparently looks something quite suspicious. So I am a bit more reluctant, to be honest. So there is a price support here, 115 rupees perhaps, or 120 rupees where the stock is. There is a price support. So to that extent, yes, from a valuation perspective, one can argue it's fine with Yes Bank. But clearly from a business model perspective, do you think it can really do very well? I think it's quite difficult as of now to take a very positive or a convincing stance on them. And also you have to understand that Ravneet Gill comes with an experience of being in a foreign bank for 25 years. Now, things are quite different. Running a mass market private sector bank in a country like India is very different from being a CEO of a foreign bank. So challenges are quite plenty on his plate, and I seriously doubt execution capabilities, specifically in case of Yes.
So immediate risks are timing of capital raise, price of capital raise, growth, and still some of the structured lending, ADAG exposure, DHFL exposure.
Yes, that's true. Yeah? Those are all of course a risk which is going to be quite palpable in case of Yes Bank. And as I said, clearly reorientation of their entire business model. See, scaling up the retail franchise is not going to be easy. Pralay Mondal moved from HDFC Bank and Yes Bank, and I don't think much has been done in Yes when it comes to its retail portfolio, right? Both on the assets as well as on the liabilities front. So, and the competition for retail liabilities is just getting tougher and tougher. You know how difficult it is to operate with so many payment banks in the country, small finance banks, and of course the existing private sector banks, and deposit growth is very difficult to come by. Yeah. So the real problem with Yes Bank is their ability to scale up liabilities franchise in a hyper competitive market. That's going to really make the entire task much more difficult. Not specific to Yes Bank, it is a challenge for all of the smaller banks also. But then that's the need of the hour for them, because only when you have a solid funding franchise, you can go on to lower risk loans. Otherwise, then your margins go for a toss big time, right? So these things would take a lot amount of time. So the course correction is not going to happen in a couple of quarters. Easily, you'll have to give 3 to 4 years, and investors need to have a lot of patience for that. I mean, why should I buy the stock for something where the returns could be quite back-ended, right? So far into the distant future.